Stop. Do not press submit if you're self-employed. If you're a 1099 contractor or if you drive for Uber on the weekends, do not file your 2025 tax returns yet. I mean it. Put the mouse down. Because the biggest mistake I see veterans make in February is filing a tax return to save money today. That could completely disqualify you from buying a home tomorrow. Heads up. The new big beautiful bill expanded some write-offs for 2025. That is great for the tax bill. But those new deductions make you look poor or paper poor to a mortgage underwriter. So do not file until a lender reviews your draft. Hey everyone, I'm Cathy Sabater and it is officially tax season. We all know that feeling. You go to your CPA, you sit in that chair and you say, please, please make the pain stop. Make me pay zero taxes. And your CPA says, I got you. They write off your car. They write off your home office, your cell phone, your snacks, your dog food. Okay, maybe not the dog food. And you walk away feeling like a genius because you owe the IRS zero or close to $0. High five. But then you come to me and I have to be the bearer of bad news because the tax returns that made you happy, it's the same tax return that makes a mortgage underwriter cry. Today, we are going to go deep. This isn't a 2-minute update. I'm going to teach you the secret math of self-employed mortgages. I'm going to debunk that 2-year rule myth. And I'm going to show you how we can legally add back income so that you can actually buy a house. So if you want to buy a house in 2026, this might be the most important video you watch all year. The 2-year rule myth. Let's start with the biggest, is it a lie? Is it a misconception in the mortgage industry? Raise your hand if a lender has told you, sorry, you're self-employed, you need 2 years of tax returns. Come back later. I hate that rule. And do you want to know why? Do you want to know why I don't like that rule? Well, because it's not a VA rule. That is a lazy lender or AKA overlay. Remember what that was? That is the bank saying, we don't want to do the paperwork. So we're just going to say no. Here's the real truth. Yes, the automated system prefers 2 years. The computer's like a pattern. They like boring. But the VA handbook allows for 1 year of self-employment in specific scenarios. Let me tell you a story. Let's call him Steve. Steve was an electrician in the Navy for 8 years. He gets out. He works for the local company for 2 years. He's W-2. He's stable. Then Steve says, I'm tired of making money for someone else. He starts Steve's Electric. Same job, same tools, same customers, maybe, maybe not. But the only difference is that now he is the boss. He's been in business for 14 months. A standard bank tells him, you're a risky new business. Denied. He's been doing this for a decade, 10 years. Now, a VA underwriter can look at it and say, this is continuation of employment. So here is the question. Did you start a business that is completely new? Like you went from being a nurse to a dog walker. Okay, that is risky. That needs 2 years. But if you went from W 2 truck driver to an owner operated truck driver, that is the same job. And with the right documentation and a strong explanation letter, we can often fight for 1 year approval. So if you've been denied, ask yourself, did the VA say no? Or did the bank just not want to do the work? Let's talk about the write off trap. Okay, class is in session. This is called the write off trap. Now, why is it called that? Because your CPA, their job is to lower your taxable income. My job is to find your qualifying income. And those are usually two different numbers. Here's an example. Let's say you made $100,000 last year, gross sales. Feels great. Six figures. But then you write off $50,000 for the truck, $20,000 for mileage, $20,000 for equipment. Your net income is $10,000. To a mortgage lender like myself, you make about $800 a month. You qualify for get this, a tent under a bridge. But wait. There is good news, I promise. It's called add backs. Have you heard of depreciation? Depreciation is one of my favorite words in the English math language because it is phantom money. You buy a truck, $50,000, it's your work truck. The IRS lets you deduct. It looks like you lost $50,000, but did you actually take $50,000 cash and burn it? No, it's a paper loss, a tax accounting move, and because that money didn't actually leave your bank account, the VA allows us to add it back to your income. Same thing with mileage. Part of that is just wear and tear, depending on the setup. We can add back a portion of that too. So the point is, just because your tax return says you made $10,000 doesn't mean we think you only made $10,000. We need to look at your cash flow, not just your taxable bottom line. Here goes another one. Declining income. Now, let's talk about the elephant in the room. The economy, maybe in 2024, was the best year ever. You crushed it. But 2025, it kind of slowed down. A big bank sees income drop from 100K to 80K, and they just panic. Okay? It's declining income. The business is failing. Run away, run away. Conventional loans often assume the worst, but the VA, sometimes called common sense, rare, right? A real VA underwriter asks, why did the income go down? Did the industry crash? Okay, that's a problem. But did you take time off for a baby? Did you get sick, or did you have to care for another parent? Did you choose to work less because you could? That is the difference. If you can explain the why and how income is stable now, we can often make the deal work. And this is where VA is unique. VA looks at the full picture: residual income, savings, your debt levels, So don't disqualify yourself because you had a slower year. Let a human take a look at it. Okay, here goes the next topic, the 1099 gig worker. Now, I want to talk directly to my 1099 contractors, IT consultants, freelancers, gig workers. You feel like an employee, you work full time, you answer to a boss, you live on Zoom, but at the end of the year, you get a 1099, not a W 2. To the bank, you are a business owner. Congratulations, you are your own CEO. And that means your taxes matter even more. Here's the February horror. I had a client, let's call him Mike. Mike is an IT consultant making about $150,000 a year. His CPA got creative. Meals, travel, internet, rep portions. He wrote off $100,000 in expenses. Mike was thrilled. Kathy, look, I only had to pay taxes on $50,000. He saved me maybe $25,000 in taxes until he tried to buy a house because to the lender, his income was only $50,000. He qualified for maybe a $200,000 in this market, depending on what state you're in. That might be okay. That buys you, in California, a parking space. So let's say Mike saved $25,000 in taxes, but lost hundreds of thousands in buying power. So you have to choose this month. Do you want to be tax poor or house rich? Usually, you can't be both in the same year. The strategy. So Kathy, what do I do? It's February. I haven't filed my taxes. My CPA is emailing me. Well, here is the strategy. Do not file it until a mortgage professional reviews it, which means you can get a draft, right? You don't file, you get the draft. You tell the CPA, right, because we need your permission to send me the draft. Do not submit it yet. Then send the draft to me, rerun a simulation. I call it the grid. You'll have option A. File it as is, save money on taxes. Here is the house you can buy. That's fair, correct? Option B. Adjust a few write-offs. Pay maybe a little bit more in taxes. I'm sorry. But here's how much more you can buy. You need to see both numbers side by side so you can make an informed decision. Now listen, listen to me. You cannot just amend it later. If you amend your tax returns right before applying and your income suddenly jumps, underwriters are going to look at that differently. They may flag it, they may question it, or refuse to use it. You may have to get it right the first time. Self-employment is the American dream. Owning a home is an American dream. You should be able to do both. So before you sign that return, let's take a look at the draft. Comment draft below and I will review and provide you with the numbers so that you can see side by side, pay less taxes, you qualify for this, pay a little bit more taxes, but qualify for more. Okay? So don't let IRS stress you out too much. And hey, if your credit history has a bigger scar than just taxes, I'm talking about bankruptcy or foreclosure next week. I'm breaking down exactly what the waiting periods are. And spoiler alert, it's not 7 years. It might be as short as 12 months, depending on your scenario. So make sure you subscribe, and I'll see you later.